In 2015, a ride across San Francisco cost about $6. Today, that same ride costs. By the time the company finally turned its first full year profit in 2023, it had deliberately burned through more than $30 billion. And that wasn't an accident, that was the exact strategy. Undercut every fare below cost for the better part of a decade, until you stopped comparing Uber to anything else. Every cheap ride you took between 2013 and 2019 was part of that bet. It was paid for by venture capital, built to feel like the normal price of a car ride. Your brain couldn't tell the subsidy from the real thing. It just filed away that low number and called it the price of Uber. So when the subsidies thinned out, a pandemic gutted the driver pool, and fares climbed back to what a ride actually costs, riders felt robbed, but nobody had stolen anything. This is the story of how a company spent $30 billion teaching you the wrong price, and what happened when they simply stopped paying you to ignore the truth. Here's the mechanism most retrospectives skip. Uber's real advantage in those years wasn't the app, it was the size of its war chest. Every ride booked below cost worked like a small bribe, paid by investors, teaching riders that this was simply what a car ride should cost. Behavioral economists call it anchoring. The first number you see becomes the ruler you measure everything against, often for years. Uber's early fares became that ruler for an entire generation of riders. The real cost, driver pay, fuel, insurance, vehicle wear, was always higher than what showed up on the screen. Riders never saw that number. They saw the discounted one, and it became their baseline for what normal meant. The burn rate accelerated fast. SoftBank's Vision Fund didn't just back Uber, it backed Uber's rivals too, pouring billions into Didi in China, Grab in Southeast Asia, and Ola in India, betting that whoever survived the regional bloodbaths would own the market. It wasn't cautious analysis. It was one fund chasing the same trend across three continents, then taking equity stakes in the winners either way. Fare wars turned into subsidy wars. By the time Uber filed for its 2019 IPO, its accumulated losses had already climbed past $8 billion, with no clear timeline for turning a profit. What happened next is the part investors still don't love discussing. Uber went public in May of 2019, and Wall Street wanted something the growth story had never required: actual profit. Fares started drifting upward. Then, less than a year later, the pandemic hit, ridership collapsed, and thousands of drivers left the platform entirely. When demand roared back in 2021, driver supply hadn't caught up, and prices spiked even harder than the post IPO trend alone would have produced. Riders didn't experience any of this as the market rebalancing. They experienced it as betrayal, a company suddenly charging more for the same ride. That's loss aversion at work. A price increase feels far worse than an equivalent discount. The numbers tell the rest of the story. Uber didn't close a fully profitable year until 2023, 14 years after it was founded, and only after trimming incentives, raising average fares, and absorbing several more years of losses along the way. Some from subsidized rides, and later, billions more in paper losses on the stakes it held in rival companies like Didi and Grab, as their valuations swung. Riders who had anchored on 2015 era pricing saw real increases in many markets and called it price gouging. In reality, those fares were finally closer to what a ride had always cost to provide. Drivers, meanwhile, had spent years watching their incentive bonuses shrink as the subsidy taps closed. The company that once burned tens of billions to win loyalty spent the next several years rebuilding trust with math, not marketing. This isn't only a ride-hailing story, it's a blueprint for how subsidized markets rewire expectation. When a company sells you something below its real cost for long enough, your brain stops treating the subsidized price as temporary and starts treating it as the baseline truth. For years, analysts praised Uber's growth curve while glossing over its unit economics, what it actually cost to deliver one ride. Growth numbers made headlines. Profitability numbers were inconvenient, so they got less attention. That gap between what's exciting to report and what's actually sustainable is where investor money and consumer trust both quietly go to die. The same trick is running right now, wearing different logos. DoorDash didn't post its first fully profitable year until 2024, 11 years after it was founded, and most of that gap was filled the same way Uber's was: discounts, free delivery windows, and promotions that trained customers to expect a price the business wasn't actually making money on. Grocery delivery startups and AI subscription tools are following the identical playbook today, burning investor cash to train you to anchor on a price that can't last. Every limited time 40% discount is quietly rewriting your internal price calculator, the same way Uber's early fares did. When those companies eventually need to turn a profit, and most of them will, the price hike will feel like a scandal. It won't be. It will just be the bill arriving years late with interest. You've done this yourself more times than you'd probably admit. The streaming service that hooked you with a free trial, the subscription box that led with an introductory price, the app you keep paying for because, well, you already committed. All of it runs on the same wiring Uber exploited at scale. Your brain doesn't compare prices to reality, it compares them to whatever number it saw first. Quietly broke. Real stories about money that nobody tells you. The tragedy isn't that Uber tricked you, it's that it barely had to try. So, what do you actually do with that? Not much, and that's kind of the point. Awareness alone doesn't undo anchoring, but one habit helps. Every time a price feels unusually low, ask what it costs the company to give it to you and what happens when they stop. A free trial has an expiration date built into its business model, not just your calendar. A 40% delivery discount is marketing spend with your name on it. None of that means don't use the app. It means don't mistake the intro price for the real one. The gap between the two is exactly where every version of this story starts. A few of you already know where this is going, and you're probably typing it right now. Okay, but Uber still gave us something taxis never did. Fair, convenience, safety features, transparent pricing before you got in the car, all real. This isn't an argument that Uber was worthless. It's an argument that the price you paid for it was never really the price. Those are two different claims, and it's worth keeping them separate. Here's the part nobody tells you. Price wars don't end when one company wins. They end when you stop noticing the price at all. Uber didn't need you to believe the ride was cheap forever. It just needed you to stop checking. That's the real business model behind every temporary discount you've ever fallen for. The war was never between Uber and Lyft, or Uber and Didi. It was between your memory and your math, and your memory lost almost every time. So next time you open a delivery app or a ride app, take one screenshot of the price. Just once. Come back to it in a month and see what your brain quietly forgot. If this video changed how you'll look at your next cheap ride, subscribe. Quietly Broke breaks down a hidden money story like this every week. Drop a comment. What's the one app or subscription you swear used to be cheaper? And send this to the friend who still brags about their old discounted Uber rides. This video is for general educational and entertainment purposes only. It is not financial advice.